The Middle East benefited greatly from the rise in oil prices to their highest point in more than a year. In order to make up for losses experienced before to OPEC plus production cutbacks, Saudi Aramco has resumed purchasing minority holdings in privately held Chinese refineries. It is relishing the fact that oil prices have been over $10 per barrel over its estimated fiscal break-even point for a considerable amount of time. The Saudi production cuts of recent months have not only improved the stability of the Middle East's finances but have also significantly worsened Dubai backwardation, with the cash-to-futures gap of the middle sour benchmark recently rising to almost $3 per barrel. Dubai's rise from month to month was 55 cents a barrel, which paved the way for yet another hike in formula prices. Typically, companies like Saudi Aramco or SOMO also consider the refining margins, and August 2023 may have been the most profitable month for refiners overall, thanks to rebounding cracks in diesel and gasoline. Saudi Aramco, the nation's oil company, was predicted to raise Asian prices significantly in such a situation. Surprisingly, there was no increase in OSP as expected. Arab Light now commands a $3.60 per barrel premium over Oman/Dubai thanks to the 10 cents per barrel increase in Saudi Arabia's medium sour grades. Arab Super Light, a very uncommon condensate-like grade that sees 1 to 2 cargoes per month, was the only Saudi grade to see a significant price increase in October. It was raised by 50 cents per barrel. Overall, the lack of price ambition was a result of recent, much reduced Indian nominations as well as broader concerns about the health of Chinese demand into the latter months of 2023. India is expected to import less than 500,000 BPD of Saudi oil this month, which would be the lowest level in almost a decade. Given that Saudi Arabia sets the bar for other nations' pricing policies, the temptation to increase the cost of Asian formula was undoubtedly present. For its customers in Europe, Saudi Aramco also reduced formula prices. Every grade in both Northwest Europe and the Mediterranean saw a 10 cents per barrel decrease in comparison to September OSPs. While the modest increases in Asia were unexpected, the market had been expecting tiny month-over-month declines in Europe, where spot-traded differentials have been falling for a few weeks now. In addition to concerns about demand, increasing availability of Saudi crude may be another reason for such careful pricing until October. If anything, Saudi exports have increased this month compared to August by 300 to 400,000 barrels per day, and even with output remaining flat, this trend may persist in the future. The OSP of Arab Light now trades at a massive $7.45 per barrel premium to the Argus Sour Crude Index, making the US the only market to see formula prices increase, this time by a consistent 20 cents per barrel. The National Oil Corporation of the UAE, ADNOC, has been active in and out of the oil markets, launching new seawater treatment facilities for its onshore production and completing preparations for the COP28 summit in Dubai in 2 months. Pricing-wise, however, the nation's light sour Murban standard has grown significantly in comparison to Dubai, albeit it is still a little amount less than the $3 to $4 per barrel premiums witnessed earlier this year. In comparison to September, the outright price of Murban for October loading cargoes jumped by $6.50 per barrel, reaching $87.28 per barrel. Surprisingly, after being sold at parity to Murban in September, the disparity of Upper Zakum, a grade that is extremely comparable to Dubai in terms of quality, was reduced by 60 cents per barrel. Given that China receives approximately 2/3 of all Upper Zakum goods, the decreased gap may indicate that China's influence will wane over the next months. One of the most intriguing recent developments in the larger Middle Eastern region to observe has been the interaction between Saudi Arabia and Iraq. In contrast to Saudi Aramco, Iraq's national oil marketer SOMO raised the price of Basra Medium by 40 cents per barrel and Basra Heavy by 30 cents per barrel in accordance with the Asian formula. As a result, the spread between Arab Light and Basra Medium has decreased to $1.80 per barrel, the lowest level this year for the first time. When cheaper Russian barrels are used as the baseload by many Indian refiners, who then choose between Iraqi and Saudi prices as their primary Middle Eastern oil suppliers, the fall in India's purchases of Saudi crude illustrates this pricing rivalry well. Iraq's oil exports to Asia are ultimately dependent on 2 major customers, India and China, who together account for 85% of Asian shipments. If any of these two were to stop making purchases, Baghdad would need to quickly find new customers. Regarding Europe, Iraq now faces various challenges as a result of the sharp increase in dated Brent. In contrast to Saudi Arabia, the benchmark for Iraqi formula prices for European importers is dated, which has typically been $1.10 to $1.2 per barrel higher than the futures contract. The price reduction for Iraqi oil in Europe is substantially more than for Saudi Arabia, due mostly to the strength of dated Brent, as SOMO reduced the October OSP by 50 cents and 40 cents per barrel for Basra medium and Basra heavy, respectively. After August saw the highest ever volumes of Iraqi exports to the European continent, just shy of 1 million BPD, the second highest this year was at only 820,000 BPD, maintaining Iraq's European market became a matter of principle. SOMO wanted to let its regional buyers know that it understands their concerns about dated Brent. Should dated abruptly revert to parity with ICE Brent, as was the case for the majority of the summer, such a tactic might also backfire. Following the US-Iran prisoner swap, Tehran was finally able to access its funds that had been held in South Korean banks, adding about $6 billion to the country's national coffers. However, there has been absolutely no change in Iran's exports, with NEOC solely concentrating on the Chinese market to increase exports. NEOC increased the October formula price of Iran light to Asia by 5 cents per barrel to a $3.50 per barrel premium versus Oman/Dubai, even lower than Saudi Arabia, despite the fact that it was largely an academic exercise because Iranian cargoes are typically sold at double-digit discounts to Dubai on a spot basis. Iran's energy officials have spent the most of the summer months hyping the potential of the Middle Eastern nation's oil output, but it appears that no additional increases will be made above the 3.2 million barrels per day that Tehran purportedly already produces. Exports from Iran are still fluctuating between 1.4 and 1.5 million barrels per day, as record-high domestic fuel consumption forces Iran's oil sector to maximize refinery runs rather than export crude oil as is. On the heels of a remarkable 110,000 BPD demand growth in 2018, the Middle Eastern nation's gasoline demand surged by 70,000 BPD to a record 730,000 BPD in 2023 alone. While Tehran has bragged that debottlenecking had increased the processing capacity of the nation's biggest condensate splitter, Persian Gulf Star, to 455,000 BPD, the surge in gasoline demand has thus far outpaced the increase in refining capacity. With the third CDU of the 615,000 BPD Al Zour refinery coming online, Kuwait is finally able to increase the variety of products it offers, continuing its metamorphosis from a country that mostly exports crude to a player in all market segments. The most recent setback in the downstream expansion project was a power outage that rendered the Mina Al Ahmadi and Mina Abdullah refineries inoperable in the middle of the month. Kuwait's national oil company KPC chose a pricing strategy for its October formula that fell somewhere between Saudi Arabia's modest price increases and Iraq's decision to follow market cues and raise OSPs significantly. In comparison to Oman/Dubai and September OSPs, the benchmark grade Kuwait export crude for the Asian market was increased by 20 cents per barrel. The October OSP was reduced by a full $1 per barrel for both Northwest Europe and the Mediterranean, despite Kuwait's continued exclusive concentration on the Asian oil markets and its complete lack of oil exports to Europe. KPC's price reductions for potential European buyers outweighed those of other producers. These revisions are unlikely to have any noticeable effects, though, given they continue to be $4 to $5 per barrel more expensive than Iraq's Basra medium, which is also priced off dated Brent. What are your thoughts on Saudi Arabia and OPEC+, and do you think they can crush the US economy? Let me know down below. If you want to continue to learn about business investing and financial education, we have got this video waiting on the screen for you to check out. Don't forget to give this video a like and subscribe for more videos like this. Thank you so much for watching, and I'll see you in the next one.